Hi, welcome to Calibre Investment quarterly briefing for September 2023. Pretty interesting period at the moment. We're about a week on from the election in New Zealand, so we're going to cover the impact of that. We're still being dominated by this inflation super cycle and the interest rate impact from that, so we're going to cover that. We'll cover a bit around global growth, and then we'll push on to markets and portfolios. So the election, we've ended up with not having a result that gives us too much certainty at the moment. National and ACT obviously can't form a government by themselves, so they may have to rely on New Zealand First. We've been getting asked a lot of questions about what the impact of the new government will have on the economy. In terms of macroeconomic impact on the real economy, it's not going to be huge. Political parties in New Zealand tend to be pretty centrist, and so their policy impact this time around there wasn't much difference really. Property investors will be a wee bit happier with deductibility of interest coming back online, and also the bright line test for capital gains coming back from 10 years to 2 years. The fiscal packages were about the same from the analysis that various economists did. We of course don't read too much into the electioneering campaigns in terms of the puffery and so on that's out there. So really we don't see too much difference going forward in terms of the change of government. We probably would like to have seen a bit more addressed around things like tax reform, productivity, a more comprehensive nature around migration policy, household debt, and also trying to address the housing in terms of a proper economic focus and allocation of capital. So it was unfortunate that we didn't see any of that from the main parties or from any of the minor parties actually, and so that's part of the reason why we're not seeing a huge impact in terms of the change of the government. But one big factor that was raised during the election and is continuing on is the inflation impact, and as you can see from this graph, we are starting to see inflation come down, especially in the US, that major economy. Inflation peaked at around 9.1% in the US, which is huge for that economy. We actually have one of our team members lives in the US, and he was saying that his grocery inflation, or the inflation that he was experienced when he went to the store, was actually closer to 20%. So it's been a massive impact in that economy as it has here. That inflation rate came down to about 3% in the US, but it's bounced up a little bit to 3.7%. That's actually significant because that's one thing that the central banks are a bit afraid of, is that this battle with inflation will probably take a bit longer, and they are worried that it won't necessarily be beaten in one go. That is, it might bounce up again. In those numbers in this graph, you can see that the rate of inflation in New Zealand has fallen from 6% to 5.6%, and we're seeing some impact from that on things like the currency. This next graph is an interesting one, and essentially what we're looking at with the black line here is, we can see this massive spike as part of the stimulus packages that were brought in to try and combat the slowdown in the economy due to the pandemic. We can also see now that massive fall off in that same stimulus and that growth in money supply. So we've had a massive ramp up in growth and then a massive fall in money supply. And that's what that massive ramp up in growth was one of the major drivers of the inflation problem we've got at the moment. So we can see it's come down really quickly, and we'll get to the impact of that as we move through the presentation. So we can also see that the OCR has been ramping up quite quickly as well, and that's in response to the inflation problem. So it's been a global issue, this inflation. It's all the way through Europe, as well as the US, New Zealand, Australia, Canada, and so on. And as you can see from this graph that while inflation has come down rather quickly, or more quickly in places like the US, it's still really sticky in New Zealand. So we've peaked out at just above 7%, but we're only down to 5.6%, and that's after a few months of effort of trying to get it down. So it's a bit stickier in New Zealand. The part of the issue with the inflation coming down so fast in the US is actually they have addressed the supply chain side of inflation quite quickly. So inflation started on the supply side during the pandemic when ports and factories and the supply of goods slowed down dramatically for obvious reasons. But what's happened now, as you can see in this next graph in New Zealand, it's actually shifted more to the services side, and that's what Treasury departments and central banks were really worried about, is that the inflation would actually shift into the services side. 80% of a developed economy is essentially services rather than goods manufacture and so on, that makes up the rest. So from this graph you can see that the red component of the bars is actually the services inflation, and that's where it's shifted in New Zealand and other parts of the world. So what we're seeing is that wages are have been quite strong in terms of wage growth, and what the central banks and Treasury departments were really scared of, what kept these guys awake at night, which was the development and evolution of the wage price cycle. And so what that means is that as prices go up, employees go to their employers and say, I'm facing price increases at the grocery store, I need a wage increase. So the employers give them the wage increase, but to cover that cost, they have to put their prices up. And so that's that horrible wage price cycle, because that just repeats, of course. And so that's where we're at, and that's what the central banks, like the Reserve Bank of New Zealand, have been concerned about. So we're there, and that's what we're combating at the moment. And as you can see from the graph, we've also had pretty low unemployment. So that's also resulted in skill shortages, which has also put pressure on wages. So we've seen people, as I said, people getting quite reasonable wage increases, both because of inflation and because of the employment strength at the moment. So you can also see in the US the unemployment rate is at historical levels in terms of how low they are. And they've ticked up slightly, but that US economy is still growing very strongly in terms of job growth. They had 336,000 jobs created in September, which is still massive, and that number is well above where economists and other economic commentators thought it might be at this stage of the cycle. And so again, what we've seen is that the US Federal Reserve has come out just recently and said that these interest rates, they may be peaking out now, but they will stay higher for longer. So that's where we're at the moment, pretty much around the world. In the developed economies, we are seeing that the interest rate cycle is pretty much peaked after a really steep rise, as you can see by the graphs in terms of the steepness of the rise in those interest rates. That steepness is actually, we haven't seen that for a number of decades. This is one of the fastest increases in interest rates in history, and so that's actually having a big impact. And so in New Zealand, for example, too, a couple of the major banks thought we might have to have another increase from the Reserve Bank of New Zealand, up another 0.25%, which wouldn't have pleased mortgage holders. But the recent downtick in inflation from 6% to 5.6% may take pressure off that requirement to raise rates. But we are seeing the impact of those rises in interest rates, as you can see in this graph around consumer confidence, has really dropped away over the last few months, and retail, just looking out there in the economy, it does seem that retail is rather soft at the moment, and we are seeing even transport firms and so on reporting that they're not getting returning loads and so on. So we are starting to see a bit of softness in some sectors of the economy. Other sectors of the economy are continuing to go quite strongly because, as I said, we've got low unemployment and we've had good wage increases. But those interest rates and the impact on the consumer and mortgage holders will actually have an impact. And you can see from this graph of household debt, that 168% of disposable income is a very high level of household debt. And so from that we can see what the impact of a rise in interest rates is going to have on these mortgage holders. So a lot of people are rolling off mortgages of around 3% into mortgages of 6, 7, 8%. And that means that their servicing payments are going to increase dramatically. So that means that consumers will be spending a lot less on discretionary items in the economy. So it's interesting, we were on a research trip recently in Australia, and the Reserve Bank of Australia actually reported, it was reported in the Australian Financial Review, that the Reserve Bank of Australia has estimated that 18% of fixed rate borrowers will have negative cash flows when they roll over onto variable rates. So that's not an insignificant number, that's really huge. So that's where the impact from the rise in interest rates will come from, and that will have quite a major impact on the economy. So what the central banks are trying to do, obviously, as we've heard a number of times, they're trying to create a soft landing. So a hard landing would be a deep recession, a lot of business failures, a lot of unemployment, a lot of mortgagee sales, huge disruptions to people's lives. A soft landing is a bit of probably a recession, but not a big one, a bit of a tick up in unemployment, but the impact is not too bad. So a few months ago, the commentators were pretty evenly split. About half the commentators thought that we would have a hard landing, and about half the commentators thought we would have a soft landing. But now we've actually shifted, and we've seen that in the market sentiment, financial market sentiment as well, where the vast majority of people have up till recently been picking that we will actually have a soft landing. And in fact, to the extent that a third option has been introduced into the conversation in terms of people thinking that we could even have no landing, and so meaning that we wouldn't even enter recession, we would just slow down a bit, but there wouldn't actually technically be a recession. And so, as I say, that's been reflected in the share markets. That's why we've seen a bit of a rally this year in equities offshore. So just in summary then, inflation, we've been trying to do too much with too little. Inflation is still driving the environment very strongly. Interest rate rises have been very steep, and now we've reached a point where central banks are indicating that these interest rates will stay higher for longer, but we are also probably at the peak, or one move away from the peak of the rate rises in most of the developed economies in the world. And we've also had this big shift from the perception by a big chunk of commentators and observers that we were going to have a hard landing to a much more benign impact. So just looking at the geopolitical side of things, because that's not insignificant at the moment either. So obviously the Ukraine war is still having an impact, but now we've also got the Israeli-Palestine conflict. And at this point, at the time of filming, we've just had Joe Biden, the US president, visit Israel and try and steer them away from just a massive ground offensive in Palestine. How successful that initiative from him will be, we don't know yet. But what the US is afraid of, and others, is that this conflict spreads into a much broader conflict in the Middle East involving Iran and so on. And so that then would have a major impact just from a financial perspective, apart from the humanitarian disaster. They would have a major impact on things like oil prices and cause a major upheaval. The more extreme commentators said that may actually spark a recession, but that's at the margin, those views. So the US, though, is doing quite a good job at the moment of trying to keep a lid on things. They have put a lot of time and effort, both Joe Biden and the Secretary of State, Anthony Blinken, have gone to Israel and are also speaking to the Palestinians. But they've also sent not one but two carrier battle groups to dissuade other people from entering the conflict, which is a very good step as well. So what an interesting outcome of rising interest rates is something we call stranded assets. And so as you can see in this picture, the downtown San Francisco has been going through an interesting period where it's not just interest rates, the pandemic, and also this work from home initiative that's been going on across the world, but especially has taken hold in places like San Francisco, has meant you've got office vacancy rates up above 30% now, and that's absolutely huge. Factor in also rising interest rates, which is not good for any asset class, but especially property, and also factor in that a lot of these office blocks and so on and developments are owned by private equity firms who have huge amounts of leverage. And what you've got is actually a set of assets now that are what we call stranded, because the problem is that the market value for those assets has fallen dramatically. So those owners would have difficulty shifting those or clearing the market or shifting those office buildings onto other purchasers. And so they're basically, as I say, stranded assets. We're starting to see stranded assets in New Zealand a bit in terms of the property market as well, because people have seen property values drop. They're seeing higher interest rate servicing, so there might be a requirement to sell, but they can't sell into this depressed market. So we're starting to see just this dynamic of stranded assets. So that's one outcome of rising interest rates. Just moving on to global growth, as we said, the developed economies, surprisingly, for all the rate rises, are still trucking along quite nicely. So there's some sectors, as I said, have a bit of softness, but generally they're doing okay. China is a special case that we need to focus on, because China's not going to provide the same level of growth that we saw in the past. After the global financial crisis, they provided about 30% of global growth and helped the global economy enormously by doing that. But they have been slowing down quite a bit. Part of it was the zero COVID policy, but they've opened up after that. But they haven't bounced out of that in terms of growth in the way in which we thought they might. So one of the big problems, as we know over there, is property. Property makes up about 25% of their economy, and so we've seen property developers get into real trouble with debt and so on, and so the whole sector has actually been quite problematic. They've had problems with non-bank credit providers, and they've had that problem for a number of years, but now the property market is exacerbating that a bit. They've tipped over the population threshold, so they're now in the phase where the population will start running down. They have more deaths than births each year. And Xi Jinping is quite a different premier than the previous incumbent. So he has certain aspirations that sort of hark back a lot more like Mao in terms of positioning China, and he's less sort of brutally commercial like Deng Xiaoping and Hu Jintao. So what we're seeing from Xi is that he will be prepared to have the economy go through a bit of pain to achieve political and philosophical positions where previous premiers weren't. So overall, what that means is that we're probably not going to see the 6% growth from China that we have in the past. It's probably going to be about the 3 to 4% mark, and so we're watching with interest just to see what sort of stimulus is provided, especially for the property market. The government has stated that they will provide stimulus, but we haven't seen much detail on that yet. But Asia contributes quite a bit to global growth, and China is responsible for about 35% of that. So India makes up about 15%. So India is an interesting country at the moment. Its demographics are quite different from the developed world and China's, in that it is much more of a pyramid, meaning that it has a lot of younger people coming through the system, and obviously they will move into wanting to establish homes and consume goods and buy fridges and things like that. So India is probably going to be one of the most dynamic economies in the first half of the 21st century. So just looking at markets and the portfolios, as we can see, short-dated interest rates are up. Long interest rates are also up, and so at much healthier levels, and it doesn't seem that long ago, but long, 10-year bonds, government bonds in New Zealand during the pandemic were 0.5%. They're now 5.6%. So that's been quite a big shift up. Currency, the US dollar has been very strong, and New Zealand is down a bit, and that has benefited the portfolios quite a bit. So during 2023, share markets rallied quite strongly, and there were two reasons for that. That shift from that we were going to have a hard landing to a soft or no landing has been very positive for sentiment in the share markets. The other shift was that prior to the US Fed coming out saying that interest rates were going to stay higher for longer, there was a sentiment that with the softness, with the economies doing okay, not crashing but doing okay, that interest rates would come off a lot sooner. So that also drove quite a strong rally in 2023. In October this year, we have seen a bit of a correction when the US Fed came out and said interest rates would stay higher for longer. So there's a bit of, in the markets, there is a bit of watching what goes on in that regard. In the portfolios, we've continued to maintain that alignment in terms of objectives, meaning diversification continues to prove to be very effective. The portfolios benefited really well from the share market rally, and so they've done really well. Risk management is absolutely critical now. It always is, but in this environment, it's really, really important. So we have continued to maintain our monitoring program and the risk management process that we follow, and that's proven to be provide a really good outcome for the portfolios. As for hard versus soft landing, who knows? As you know, with us, we're not in the business of forecasting because we know nobody knows what's going to happen with this stuff, and things can come out of left field, as we've seen. So the portfolios are going very well. They are very well positioned to carry on through this cycle and the next one, and that's why we do construct the portfolios the way we do. So we're very happy where things are at, so we'll continue to monitor the situation and watch what's going to happen for the next period. So we do have other videos available online. One I would point you to in particular is we recently did a video around term deposits and how people are trying to use those and how they fit generally into a broad portfolio. So have a look at that one, and we'll catch you next time. Thanks for listening. Bye.